let's come to the meeting today and talk to Jean, please, if you're still there.
I am still here, yes. Also with the mysterious black screen. And good to hear Richard's presentation just there. Good morning. Thanks to anyone who's logged in to hear what I have to say. Always appreciate there's so much content available now, and so many other things you might be doing. And so it's great to take your time. So if we move on to the next slide, please. Just wanted to give you a little look at who you're speaking to. So I'm Jean Roche, and I'm the lead fund manager of Schroder UK Midcap PLC, the investment trust. And that's the rest of the team there. Between us, over 90 years of investment experience. Some of us have a bit more than others, but we've got Andy Bruff, who's pretty well known in this mid-cap arena in the UK, Ian Staples, and James Goodman. So hopefully you think a fine team of reliable people running, looking at all the ideas. And myself and Andy are both named on the fund. So if we move forward to the next slide. So, this is a UK mid-cap focused investment trust. It has around 50 holdings. So, that's a fairly concentrated fund. And as you might expect, the four people on that previous slide, we all love UK mid-caps. And this is just trying to capture the reason that we love UK mid-caps. And as you would expect, mainly it's because of the returns that are available. And we know it internally as the Heineken Index because it is refreshed like no other, if that's not obvious. And maybe that ad hasn't been around for a while now. And I think, what's very much front of mind at the moment, actually, with the news on Network International this morning and a fresh bid on that one, is that you get your returns enhanced because you get a lot of bids actually in this space, and much more than you would in large cap. So the index is constantly refreshed, not only by companies being bought and new ones coming in, but you also have companies, I would refer to them as fallen angels, coming out of the FTSE 100 and at interesting valuation points into the mid 250 index. And of course, that's the index, the next 250 companies below the FTSE 100 in terms of market cap, excluding investment trusts. You also have companies promoted from the small cap, and you have IPOs as well. And so, it's a very sort of interesting collection of 170 or so companies. You've got a wealth of companies in very high growth niches. We have around 89 different investment themes, we estimate, across the 170 different companies. So you're able to pick out all kinds of smaller themes, and they can be, they can be working outside of the bigger economic and whatever the macro theme of the day might be. You get these small growth areas. It could be anything from cybersecurity to luxury watches or strategic board games. You've got dividend payouts, which tend to be very well covered in this part of the market at the moment, 3 times covered. And for this fund, what we like about it is, and this strategy, you have a clear sell signal when a company is promoted to the FTSE 100, because we feel that you see the best of the growth from a company in terms of its share price as it moves through through this part of the market. So we wave companies off when they move into the FTSE 100 with a packed lunch and wish them well, and then we're ready to meet them if they come back down into the mid 250 again. And you get, you have a very different sector exposure here to the FTSE 100. If you just look at the UK market, 10 companies are responsible for 50% of the market cap of the UK. So, we are, we're very interested in the companies outside of that. Talking about why this is such a great index, I think what surprises people is that it's actually outperformed most other major developed market indices over the last 25 years, including the S&P 500, or at least has been neck and neck with it. And I think that does surprise people on a total return basis. And just to remind you, these are 6 of the reasons we pull out as to how it maybe has done that. And the final part I wanted to talk about was just, far from being just a UK index, half of the revenues from the companies in this index come from outside the UK. So I'm not saying whether inside or outside the UK is better, but just that you have a very good menu of companies and exposures inside and outside the UK in this index, although it would be commonly seen as a very domestic index. It's about 50% of revenues. So if we move forward, what kinds of companies can you expect to see in our fund? of around 55 holdings. Moving to slide 3. So what are we looking for? We're looking for companies that could be the future FTSE 100 companies, companies that we think can move into that index. And so we sometimes call this the slide of doom, because as soon as you put a few companies on a slide like this, something unexpected happens. But here goes. So Games Workshop, I'm sure a lot of you will have heard of the Warhammer game, and maybe even will have played it in the past. And certainly my 2 sons are looking into it, are eyeing it up at the age they're getting to now, close to double digits. So in terms of years, but with there we see a huge US opportunity, and news of their potential tie-up with Amazon to make content, possibly driving that hobby further, and meaning that, you know, although it's a well-known hobby here, playing strategic board games with small with miniature plastic pieces and a measuring tape and some dice, that, you know, something that can really grow to become even more of an international story than it already is. And very high margins there on that one. Man Group, a fund manager which is ahead of the game in terms of its use of technology. Telecom Plus, you may have seen their utility warehouse billboards at a train station near you, and they're offering very competitive multi-utility services which simplify the job that probably most of us hate, which is looking at various utility bills across the household. So look out for those billboards, and that one we also think has huge growth potential. And then Spectris, which does advanced scientific instruments, which save companies money by speeding up what they do, and checking what they do as well. And they're exposed to pharma, auto, and the aerospace industry, as well as, you know, more general industrial. So there are, you know, 4 names that we think could be FTSE 100 companies of the future, and as you'd expect, we hold them in the fund. If we move forward to the next slide, please. And we thought it might be interesting for you to see, you know, the fund is actually focused, has a very much a capital growth focus, but as it turns out, the strategy that we run does actually deliver good dividends as well. And if you're looking for multi-baggers, and I'm sure most of us are, you could see that the dividend here has actually grown by nearly 10 times over the last 20 years. And if you compare that with what house prices have done, for example, they only doubled during that period. Milk has only doubled as well, the cost of a pint of milk. Beer has done slightly better, up 2.6 times in that time period. But I think it's quite interesting to compare those things. And, you know, this dividend has grown through some pretty hairy times, through the global financial crisis, the Brexit vote, the pandemic, and more recently, the sad events in Ukraine. So, you know, I think you could see that as a very resilient and a very resilient dividend, and, you know, very, I think, remarkable that it can carry on growing despite the rhetoric around UK markets and why you might not want to be a listed company here. These companies are managing to pay good dividends, running very strong businesses and growing their earnings, and then able to pay well-covered dividends out of that. I mentioned earlier how well those dividends are covered. So we move on to the next slide. This is just showing, you can refer to this later. I mentioned that the FTSE 100 was very concentrated in certain sectors, and that, you know, the top 10 companies actually are responsible for 50% of the market cap of the whole market. So by definition, there's a lot more interesting niches below those very large companies, which are focused in areas such as mining, energy, and banks, and also pharmaceuticals. You get just a much more interesting range of niches when you move down into the FTSE 250, and even within the industrials, you get some very interesting companies below that. Electronic engineers, which are very good in this country, for example. If you move to the next page, please. And I talked about bids earlier. I call this the Blackadder slide, actually, because of the font that's ended up on there. But what I was saying, and I pulled this together actually late last year, is that by definition, mid caps are much more likely to be acquired than large caps, because they're far more digestible size, and that helps to, so, you know, the premia you get when a company is taken out. I mean, last year some of the premia were up close to 100%. This year to date is more like 40-50%, but that enhances the returns in the fund. And actually, I thought in the Blackadder handwriting there, actually, that there was some pent-up demand coming through at the end of last year, that there must be some sort of appetite coming up at the start of this year. And lo and behold, we've seen 4 bids in the last week for UK small and mid caps. And some, you know, quite large mid caps, actually. Dechra, an animal pharmaceuticals company, Network International, We've also had year-to-date Dignity, we've had John Wood more recently, and the proud owners of the Franco Manca brand also being bid for. Fulham Shore, that company is. So I think you are seeing, and it's interesting, it's PE as well that's bidding this year, whereas it was strategic money last year. For example, the acquisition of Brewin Dolphin by RBC. But this year it's, and very much in the last week, it's been PE deciding that actually that valuation is looking very attractive now. And I would tend to agree with them. So if we move forward, I mentioned that you can make very good money in UK stock, but it's not all about takeouts, generating those returns. And actually, my colleague and I, James Goodman, were really interested to see that the UK beats the US in terms of the number of multi-baggers created, in terms of the potential for to find a UK company that's a multi-bagger is better in the UK than it is in the US, because of all the stocks we analysed across the UK and the US markets. We looked at the number of stocks you could actually invest in, with so certain minimum market capitalisation, and then the number that returned 30 times or more in the 30 years to the end of December 2022. And we found that you had a better chance of getting one of those in the UK than you did in the US, which might be surprising to many commentators who are saying that that you want to be moving out of the UK and into the US, and indeed much of the money that's moved abroad from an investment point of view and out of the UK. But we actually we did this work for the LSE on the 30th anniversary of the FTSE 250 index late last year. And obviously it's Peter Lynch who coined the phrase multi-bagger to begin with. But we thought, how many companies have returned 30 times over the 30 years of the existence of the FTSE 250 index, which has been such a strong index. And actually it's quite a high number of them. And if we move forward to the next page, we can see that actually a lot of those companies are pretty well known, well loved UK mid caps. Cranswick, the maker of the McDonald's crispy burger, which maybe some of you are fans of, and I think it has its own Instagram account, that particular burger, and plenty of influencers following it. But you also have Clarkson's, the most successful global shipping services company. You also have Grainger, which is a private rented sector landlord, and HomeServe, who are insuring the piece of pipe outside your house in the driveway to make sure that if it bursts, somebody else can pay for it. All the way to Savills, which you'll know from its real estate routes and stores in the high street, as well as being an advisor globally to real estate people involved in the real estate industry. So all of these actually on this slide, this is just a selection of those 60 plus 30 baggers that we found in the UK market over that time period, and all of these names have been owned by this trust and in this strategy at one stage or another, or some of them are actually owned by the fund right now. So if we move forward to the next slide, I mentioned to you earlier, that yellow line there, that's the mid 250 index, and that's showing you that it has beaten the S&P 500, which is just below it, over the last 25 years. Now that was taken to the 20th of March, and that's in local currency, but if you do it in dollars as well, in February, the two indices are neck and neck. And actually the point really is that the S&P and the mid 250 are neck and neck in terms of returns over the long term, leaving many of the other developed markets for dust. And this trust has beaten that index, the yellow and the dark blue line there. If we move forward, another slide is just showing you some of the performance statistics over the last year, 3 years, 5 years, 10 years, and you've got a discount of, when I checked it yesterday, it was 13-14% to NAV, and the opening section of this show talked about some discounts to NAV, and so I think the audience is probably familiar with that. So you get the UK discount. The UK is inexpensive, and it's not just, you might say mid caps are generally expensive, and it's the FTSE 100 that's cheap, but actually UK mid caps at this point in time are inexpensive, and I have some data to show that in a minute. And then you get a discount to that with the investment trust. And you can see those headlines on the right. In any one day, you can find plenty of press negativity. Although I will note that the consumer confidence data from the GfK today is showing a high, relative 14-month high in consumer confidence across all aspects, including large purchases, consumers feeling a bit better about life, and that might be linked to the 10% increase in income that 20 million people have seen in April in this country, with universal credit, with the triple lock kicking in. And it's been actually a big boost to consumers in April, which we would expect to see coming through. So there's the performance of the trust relative to that very strong underlying index. So we move forward. That is just a compliance required slide. If we move forward to the next one. Yeah, I talked to you about a little bit about valuation, and that premium of mid caps has moved right back. That's the green line there on the right. And then you might say, well, hasn't the earnings season been dreadful? But actually, we've now got more upgrades than downgrades on a sort of a 1-month basis, looking back. And the 3-month ratio is quite neutral now. So earnings revisions for the companies, and lots of them have even yesterday we had Reading Northgate upgrading or the day before yesterday for the full year ahead at Q1 stage. So I think you're seeing a lot of confidence from some of these UK corporates after what might have felt like some dark days, and the valuations, as I said, looking quite attractive. So no surprise that PE is dusting down their files and starting to move forward. And the other bit I forgot to mention actually when I was talking about it, that's come out in the last week, was the HUD Group, of course. If we move forward to the next slide, then just looking at that sort of lime green line, second from the bottom, that's mid caps there, sitting at a huge discount on a global scale to most other markets. So again, a very attractive point in time in terms of valuations, and that's just on PE ratios for this year. But it's it's retrenched and looking attractive, I think, to many. And I don't show it here, but the dividend yield also on the opportunity set is in excess of 3.5% too. So on relative to what has been in the past, relative to FTSE 100 and globals, at an attractive place also, if you're looking at equities. So moving forward from here, so how do we do it and what do we do? Well, we categorize our universe into 3 different types of stocks: what we call unique stocks, then flex stocks, and stocks to avoid. And hopefully the third category is self-explanatory, but I'll give you a little bit more feel for that in a minute. But what are we looking for with these unique stocks? Well, some of those stocks I said might be able to grow to be FTSE 100 stocks of the future. They would fit into that unique stocks camp. They might have like a scarcity value, a very strong business franchise. What they do, you can't get access to that anywhere else. You can't really get access to the Warhammer portfolio or access to that growth niche by investing in any other company. They will have quality management, as you'd expect. They're able to generate above average returns on their capital employed, which is what you want to see as a shareholder. Usually they'll have strong balance sheets, and they might be a little bit more expensive than the next category I was going to talk about, which is the flex stocks. But we would look at that on a PEG basis usually, if we can, which is price earnings divided by 3 years growth, to check, what are you paying for that actual growth? So these are companies that you can't get access to by investing in anything else in our investment universe. So they're the unique stocks. So we decide whether stocks are unique. Maybe if they're not unique, are they flex stocks? So flex stocks are in industries which are undergoing quite a bit of change. There could be capacity coming in and out of that industry. There could be lots of share buybacks going on in that sector of the market. It could be a cyclical company. Often it's a company which is at a strategic crossroads. There might be a change of management. For example, a new CEO. And the valuation will generally be reflective of that. So you'd expect a lower PE or PEG, or we look at EV/EBITDA as you'd expect, at free cash flow yield, all those things. But the valuation you would expect would be a little more just lower than a unique stock, for example. And what I would say about unique stocks as well is those ones are stocks where probably the company is more likely to be acquired, because for that very reason of it being unique and exposed to a certain niche, then it's far more interesting for a potential acquirer. And then stocks to avoid, well, what are they? Well, usually they are shares in companies where management have been destroying value. So unsurprisingly, we want to avoid those. They'll tend to have poor returns on capital, maybe will have done some poor deals. there'll be often overcapacity in the industry, where supply is exceeding demand for the product potentially. And so for us, they'll be ones to avoid. And if they also have the added negative of significant accounting concerns, that will be also a reason to avoid. So I think that's probably quite clear. And so what we do is when we've decided what are unique and what are flex stocks, then we'll take the most attractively priced unique and flex stocks and put them together in our portfolio. And we like to have about 40 to 60% unique names if we can. And at the moment, the portfolio has 40% weighting in unique names, because some, stocks, while they might be unique, we might not want to own them because they're too expensive. So if we move forward to the next slide. So I've told you how we like to buy, but I have a little post-it note next to my desk as well, which says, "Don't forget to sell." That was handed to me on the first day I joined Schroder, 7 years, a bit more than 7 years ago now. So, as you'd expect, we have a selling discipline. And as our favorite reason that we are selling a stock is when it's going to the FTSE 100, so we can reinvest into a better opportunity, because many times the best returns come from stocks in the bottom 2 quartiles of our investment universe. But other reasons to sell might be frequent or expensive acquisitions, especially if lots of shares are being issued to do that. It might be just that the investment thesis has played out. We see an issue in the quality of the accounting of the company. If you see, and there actually it's, frequent exceptionals, large exceptionals, or, several years in a row of exceptionals, that would be an alarm bell for us. If they're failing to respond to disruption, if there are big changes in their industry, but they're not responding to that, not changing what they're doing to respond to that. I talked about valuation. When companies are acquired, we'll also sell. If we see a change in the sustainability behavior or in the management's behavior around ESG, we could also sell. And if we see lots of competition coming into the industry. So as you'd expect, a lot of this, if you were drawing a Venn diagram, a lot of this crosses over with the stocks to avoid side of things as well, and that category. But these are 9 reasons to sell, and we find that we have a lot of incoming on reasons to buy, but not many reasons to sell. So it's good to have this, what looks a bit like a dartboard actually, but isn't, reminding us of reasons that we would want to be selling. So plenty of reasons to be doing that. So if we move on to the next slide, an example of a unique stock, I thought that'd be useful for you. So that chap on the right, he might look a bit familiar to any of you who are fans of the Warhammer game. But just a bit more background on what we might expect from this kind of company. And what I might just pick out is that sales growth of 20% compound since 2015, since the new CEO joined the business. But as you'd expect, many reasons to pull out the quality of this one. And still looking at potential significant growth in the US. So we move forward one more. I talked about the long-term trend of outperformance, and this is since launch, which is 2003 on the far right. But moving back to the more recent 3-month period as well. But we are long-term investors. The holding period 4 or 5 years typically. But if an investment case plays out sooner than that, then we can move on and reinvest in something else. This is the best performing UK equity investment trust since launch in its sector in 2003. And I've mentioned I've been involved for the last 7 years. So I can't take all that credit. But Andy Bruff was there from the beginning, and he's still co-manager on the fund. So if we move forward from here, and the strategy is the same as it was then too. Just on my conclusion, hopefully you've gathered that this is a very tough index to beat, actually, but we've managed to do that. And I think this huge negativity towards the UK markets is just an opportunity, because we're still, we were at a site visit to see a company yesterday, and it's still very much, it's really inspiring to see management teams growing top lines, investing. We saw actually the CFO, the finance director's survey on Monday, which Deloitte carries out, showed them, being really positive. And, there are industry leaders who are growing companies and seeing opportunities and managing to grow their earnings, and then paying out good dividends, reinvesting their capital, and creating things like the McCrispy burger for us all. And, we really do have world-class businesses in this country. So we're looking for companies that can grow. They have sustainable business models. They are resilient. They'll have good balance sheets. and they see opportunities. And so we feel that our holdings position us very well for what happens next. And we do have a website for the trust, as you'd expect. So I'm sure we can share that with you afterwards if there's any demand for it. And if we move to the last slide, it's just some more statistics on the fund itself, because that's probably useful for you to refer to. Thank you very much for listening.
Thank you, Jean. That's really interesting. And sorry, I disappeared slightly in the middle, but I'm back again. I think looking at these questions, there's sort of lots of different areas to cover, but maybe we could start with a bit about how you put the portfolio together. I know you did address that a bit, but how do you decide on how big the individual position sizes should be?
Well, what I being an active manager and very much, as you'd expect, a believer in active management, what I want to make sure is that it's an active position. So as a start, I would want it to be a holding that's bigger than the size of the company in the index. And then it's the ones that I feel, as you might expect, the ones that I feel would have those unique characteristics, they would be bigger holdings. But also then it might be, if the ones where I see the biggest valuation opportunities might be bigger holdings as well. So there's no sort of hard and fast rule. But if you think we have around 50 holdings, then about 2% for each company roughly would be maybe an average sort of size. But we very much flex around that. And actually, off the top of my head, I think 60% of the weighting is in the top 20. So we do show a lot of conviction. And then we'll have holdings that are maybe just on their way out or just on their way in as well. So they'll be smaller than the plan is for them. So we'll also, it's like a topiary, where we are sort of trimming and shaping the fund, because it's like a living thing where, a stock has done very well, we'll take a bit of a trim back. But when we're, I think the question is probably around when you instigate a position, where do you want to get to? Well, the minimum would be an excess of where it is in the actual underlying benchmark. And then, moving on from that, just put it relative to the other opportunities within the fund. And then you'd obviously look at sector exposure as well when you're doing that.
Okay. Then there's a couple of questions about sort of how you manage volatility, but actually I think that sort of ties in slightly to how you manage gearing. Do you want to sort of just talk a bit about that? Right, yeah. I suppose generally how you manage risk in the portfolio.
Yeah, I mean, how do we manage volatility? The great thing about a closed-ended fund is that you don't have inflows and outflows, so you don't have that sort of market volatility or driving inflows and outflows. So you're more in control of your own destiny. I think with a good example might be the events of last September. My response to that volatility was to not do very much, because I felt that the fundamentals were not reflected on our screens, and I might have taken on some new holdings actually, but sat with my existing holdings that I was so increased my number of holdings, because I felt that good companies' shares were being sold off. So if I didn't own them already, I'd buy some more, and I wouldn't sell the ones that I already had an investment in. In terms of gearing, well, the board. The board of the trust, so we've got 4 directors, they're very much involved in levels of gearing, and we have a mandated level of gearing actually. And then on volatility, and maybe you probably want to talk about how the discount is managed. Well, again, the board they decide if there are going to be some share buybacks, and there have been in this fund. And in terms of risk management, we're very much stock pickers, and a lot of the alpha has been developed in this has been generated in this fund. The majority has been from picking stocks, but we will look at sectors as well. So, risk management in that format as well. Is there anything else I haven't covered in terms of risk?
No, I think it covers most of it. So, I mean, there must be some sectors that you don't have any exposure to. Is that true? So, energy, utilities?
Have a little bit of everything, but we are quite underexposed to real estate. And that has been a good thing as interest rates have risen. And there are a lot of REITs, in that sector as well. And they might be exposed to just one area, one asset class, one sub-asset class within real estate. And, we might feel that we prefer something a bit more diversified. But that's grown into a very large sector actually in the index. And we didn't. I was trying to. My slide deck actually has 50 in it, and I've weeded this down for this presentation today. But it does show industry exposures, and if you saw that, what you would see is that we look like we're very exposed to industrials, but that is a huge sector, and that would include stocks like Rennish, to Northgate, to Inchcape, who are exposed to the increasing mobility trends in in developing markets. So there are huge variances within that industrial side of things. But yeah, you'd see the biggest underweight would be there to real estate, which, as I say, has worked out well for us in terms of rising interest rates, and we'll probably have relative underweight to energy as well. But it's again, it's not particularly sector driven, and there's no we don't do things like, we don't avoid defense stocks, and actually we feel that they are in many cases undervalued technology stocks, so with quite attractive peg ratios.
Okay, thank you. The question was actually simply about the industrials overweight, but I think you explained that that's quite a diverse range of stocks. But are you concerned about where the economy is going generally, global economy, and suppose the UK economy too?
Well, I thought I was seeing things when I saw the words, recovery on my screen this morning. Are we at the start of a recovery? And I think, first thing to say, though, really, despite that, is, that the share prices can do very different things to economies. But I think that probably the UK economy has had a lot of negativity around it. I mentioned earlier there are 20 million people who've had a 10% pay increase in the last month, or income increase, because of the April increases to things like pensions. And I think that probably the negativity is, and you would expect me to say this, is overdone. But also, I have the happy situation where I can look outside the UK as well, because 50% of the revenues from these companies are outside the UK. And if you just look at our top two holdings, you've got Dunelm at the top, and then you've got 4Imprint, and Dunelm is 100% UK, and 4Imprint is pretty much 100% ex-UK. But Dunelm's very well able to deliver very high levels of top line growth, very high margins, sitting at 50% gross margin, paid a 40p dividend, and is gaining market share in, as we continue to make sure that our homes are comfortable and that the cushions don't look too wrecked. Speaking for myself, and that spend continues, and they continue to do it better than the competition. So I think we don't have to. Whilst the UK probably drives a lot of the sentiment towards UK stocks, you can choose all kinds of themes, and it doesn't have to be UK focused. And then having my cake and eating it. But we are seeing lots of glimmers of good news actually coming through for the UK economy, and a certain amount of stability. So I think it's very perfectly possible, and we have seen that to have plenty of companies that can deliver very good growth and very good earnings and dividends for shareholders.
You brought up a slide earlier on where you're talking about takeovers. Are you worried about the sort of de-equitization or the sort of general trend of stuff listing away from the UK that people have been talking about?
Well, it's funny because if you look at sort of US commentators as well, they're worried about de-equitization as well. So we're not alone in that. But yeah, I mean, I'd be lying if I didn't say that, it does feel when a company like Dechra is bid for, that's a unique asset, that's animal pharmaceuticals. They're the ones that are making sure that lambs, when their tails are docked, aren't feeling pain. That, when your dog has an earache, they're making those drugs to look after your dog and make sure that they're not in too much pain. And so, what you then think is, what's the next company that can come along? And happily, there are plenty of smaller companies which haven't caught the eye of private equity, which are coming through. And within the team, we have a very strong small cap franchise as well. So you can see that this gives an opportunity for maybe some smaller companies to move into the mid cap quoted space and shine. But yeah, I mean, I think that's a common theme. And speaking to people who are invested in the trust this week, actually, that is a concern that high quality companies are taken off the market. But of course, we see with particularly with private equity, it's when you have a strategic buyer, they're taken off the market and they're likely not coming back. But with a private equity buyer, the likelihood is that you might see that company coming back on the market again. So it might not be goodbye forever.
Did you have to change any way the way you approach managing the fund when we start to get higher interest rates and higher inflation after a long period when we didn't have that?
I think we sat down with the board and we talked about that we want to now beat this higher cost of gearing. So what are we seeing with that? Well, then you see higher dividend yields coming through, companies paying special dividends. But you have to ask yourself, can I beat this rate? And then also, we would have been buying companies which we think of pricing power by the virtue of these unique companies of selling into a space where there's scarcity. Are they able to raise their prices as we think they should be? And that's where we bought them. So, it's a test of pricing power, isn't it? And indeed, we have seen great pricing power amongst our holdings. So, but it does, I suppose, make you think, give you a higher hurdle to beat. You're checking that you're going to be able to do that in the way you're managing the fund.
Okay, thank you. I think there's a slide in the pack on the dividend. I don't know if we can find it.
I think it's quite near the start, I think.
Oh, I'm pushing you backwards. There we go.
Never go backwards.
So,
yes, there.
As we go forward, I think we just gone. There we go.
Yeah, excellent.
As we go forward, how important is it to sort of keep the dividend moving upwards?
Well, as you know, we're mandated to pay out 85% of the post-expenses income in dividend. So that's something that's understood. And I think, the board will take a view. It's the board who decides what dividend is paid out. You could see that they decided to be cautious in 2020. And indeed, many of the companies, some very high quality companies, for example, I'd mentioned Computer Centre, decided not to pay their dividends in 2020 because they were waiting to see how we progressed from here. So there was an element of caution around 2020 and 2021, but there you see a record dividend in 2022. So, resuming that upward trajectory. So I think there's the dividend is important, but the board took a decision to wait and see, took a pause on that in 2020 and did have a cut, but saw that the green light was there and companies started to pay dividends again. And we'd respond to what the companies are doing in terms of the dividend we're able to pay out, because, as I said initially, the main aim of this fund is capital growth. But it happens that we do invest in companies that tend to generate a lot of cash internally. And then once they've paid for their CapEx plans, often they're able to pay a good dividend as well. So it's sort of a symptom or a side product of the investment strategy. But as you can see, it's paid out consistently well over the last 20 years. And the dividend's a 10 bagger over that period, pretty much, as at 19 years. Yeah.
Yeah, great. What's the sort of turnover on the fund generally?
It's anywhere between 15 and 30%, closer to 15, 20 in recent years.
And do you have a feel for how much of that is sort of outside of your control by things moving up to 100? And how much is by you trading stuff?
Well, I'll just give you one stat. I mean, in the last, between last September and March, we only sold one that moved up to the FTSE 100. That was Weir. And I think we had one takeout. I don't think if I have a look, I don't think I have the slide in this pack because I have the data here with me though. Just give me a moment. Yeah, we had two bids. We had in that period, Micro Focus and Ted Baker, and then we had Weir Group. So that might have been maybe a third of what we sold. So, it just depends on whether we get, in years where we have lots of bids, then you'd expect that to drive things more, or years where we have more companies going into the FTSE 100. Now, we don't sell if companies do fall into the small cap unless we think the investment thesis is broken. So, most of the, I'd say the vast majority of investment decisions are actually within our control.
And one of the questions over here was, what's a recent example of something you sold?
Say again?
What's a recent example of something you sold?
A recent example of something we sold? Well, I mentioned Micro Focus and Ted Baker, which were bid for Weir Group, which went into the FTSE 100. We also sold shares in Petrofac because of management turnover there. We had, very much bought into the CEO, and he left quite suddenly. So that was a reason we sold that one.
Good. All right. I think we're sort of running out of time a bit, but thanks very much for this. If we could move back through the slides again, and then we can make sure we see the disclaimer. It's always important. But no, it is very interesting. I mean, I think there's an awful lot of negativity about the UK. And I think it's just a question of sticking with it and, as you say, picking the right companies. So good luck with the future. Thank you.
Thanks very much.
Time.
Thank you. And I think we're seeing, today I've seen a big flurry of interesting looking graphs again on valuation. So that's always an interesting thing to look at lunchtime on Friday. Have a great weekend, everyone.
Another time. Thank you, Jean.
Cheers then. Bye.
Thank you. Okay, so if we just go there, we'll be back next week talking to Alliance Trust Playbreaker, and just a quick update on what's been happening with them, because there's been quite a lot going on in the macroeconomic world. And actually, I think they've been performing reasonably well relative to most global funds. And then the week after is JP Morgan Japanese, which was a star and sort of come back a bit, but the manager's quite excited about the future, so we'll explain why. So probably to the technology problems today, but I think we start our way through it, and we'll be back next week and hope you have those sorted out by then. Thanks and goodbye.